So good afternoon everyone. Welcome to the class on investment management. Today we'll discuss very important part of technical analysis. Today we'll discuss moving average. Today in technical analysis we'll discuss the concept of moving averages. So technical analysis altogether is very important concept when we talk about technical analysis. Uh, Altogether technical analysis is very important concept. So in technical analysis, we need to discuss a very important parameter called moving average. In moving average, we'll talk about two kinds of moving average. Either we'll talk about simple moving average. So either we'll talk about simple moving averages, or we'll talk about exponential moving averages, or we talk about exponential moving averages. So here when we're talking about averages, so we talk about two kinds of averages. Either it can be a simple moving average or it can be exponential moving average. So when we talk about simple moving average, in case of simple moving average, we give equal weightage. In case of simple moving average, we'll give equal weightage to all the events which has happened in the past. So in case of technical analysis, we what we are doing, we are observing the historical price and we are observing the historical volumes. So here the historical price what we are talking about. So here I'm concentrating on the closing price. Okay, so here I'm just concentrating on the closing price of the stock. So when I'm concentrating on the closing price of stock, what I'll try to do, I'll try to find the averages. So average I can find as a simple moving average. Simple moving average, when we talk about simple moving average, so in case of simple moving average, I give equal weightage to data. Okay, so simple moving average, when you're calculating, like if I want end day moving average, so the formula for that would be the sum of value of end days. The formula can be sum of values of end days. The formula can be sum of values of end days divide by the end. So that can be the formula. So that can be the end day moving average. So this is what we follow. Okay, so this is what we follow. So in simple moving average, we'll give weightage to all the days. So equal weightage to all the days, and then what we do, we find the average of that. So in statistics, you studied arithmetic mean. You know how to find the arithmetic mean. Arithmetic mean is nothing but it is sum of data divided by number of data. So the same thing what we do in simple moving average, where we give equal weightage to all the event which has happened in the past. So like if suppose this is the price of the stock, simply suppose this is the price of the stock, you can see this. So let me enlarge my screen. So suppose this is these are the dates and these are the prices of stocks. You saw these are the prices of stock. Suppose these are the prices of stock you saw. Now what I want 10 day simple moving average. So if I want 10 day simple moving average, so what I'll do, I just take the 10-day data. So this you can see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So I'll take 10-day data. I'll do the sum of the 10-day data. So I'll do the sum. I'll do the sum of 10-day data. So this this 10-day data, I'll take the sum of that, and then this I'll divide by 10. So this I'll divide by 10. So then I'll got the 10-day moving average for me. Okay, then for next day, why we call it moving average? Why we are not calling it simple average? Because then for the next 10 days, what I will do, then for the next 10 days, like for the first 10 days, I took the data, like for the first 10 days, I took the data from, suppose for the first 10 days, I took the data from here. So like this 1, 2, 3, 4, 5, 6, 7, 8, 9, and then 10. So these were the data for the first 10 days. Then when I do the calculation, when I do the calculation, then when I'll find the average for this day, simple 10-day moving average for this day, then I'll take this data 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So I'll not take the first data, the data which I taken here. I'll not take this. So this would be the 10-day average for this. Okay, then for this day, when I find the average, then if I then this day if I finding the average, you can see this. Then for this day, when I'm finding the average, then this for this day, when I'm finding the average, so you can see this. So and then this for this, then for this day when I'm finding the average, then I'll take the data from here. So I hope you're getting the concept. That's why we called it as a moving average. Okay, so this is simple moving average. So in simple moving average, we give equal weightage to the event which has happened in the past, equal weightage. All the event we give equal weightage. So end day moving average, whenever we are calculating, that is nothing but it is a sum of data of end day. It is nothing but it is a sum of data of end day divided by the end. So this is the simple moving average. Okay. Now, when we are calculating the exponential moving average, when we talk about exponential moving average, so in case of exponential moving average, we'll give more importance to the event which has happened just now. We'll give more importance to that event. Then to that, we'll give importance to that event which has happened before that. Then we'll give importance to that event which has happened before that. So like that. So sequence wise. So we'll give more importance to the event which has happened just now, then to the event which has happened before that, then to the event which has happened before that. So everywhere in the financial market, whenever we talk about calculation of Libor, so whenever we talk about calculation of Libor or MIFR, whenever you talk about calculation of Libor or MIBOR, so in all these instances, like monetary policy review, so whenever we talk about stock market average movement, like when the index do the calculation of impact cost, okay, so do the calculation of impact cost. So impact cost basically talks about the liquidity of the stock, bid ask spread. So there in all these cases, when we are talking about here, we use exponential moving average. So we don't use simple moving average there. So in case of exponential moving average, what we do in case of exponential moving average, first we find something called K. K is called smoothing constant. So first we'll find something called K. K is called smoothing constant, where the formula of K is equal to divided by n plus 1. So this is the formula of K. So first we'll find the value of K. K is equal to 2 divided by n plus 1. N is the number of days for how many days moving average you want to find. So first we will find the value of k. K is equal to 2 divided by n plus 1. And then once you find the value of k, which is equal to 2 divided by n plus 1, then we'll find today exponential moving average. So the today exponential moving average, the formula for that is today closing price. So what is the closing price for today into k? So k is the smoothing constant plus yesterday exponential moving average plus yesterday exponential moving average into 1 minus k. This is the formula for today exponential moving average. This is what we do here. This is what we do here. This is what we do here to calculate the exponential moving average. So this is the formula what we do here. So, so you can see in this problem. So they are. So here, I want to find 10-day exponential moving average. So if I want to find the 10-day exponential moving average, first I'll find k. K is equal to 2 divided by n plus 1. So I'll find 2 divided by 11. I'll find 2 divided by 11. So that is equal to 0.1818. So this would be 2 divided by 11. Okay. So once I'll find 2 divided by 11. So now what I'll do, I use the same formula, the formula which I told you, the formula that today closing price into smoothing constant. So smoothing constant I got. Now what is 1 minus k? So 1 minus k, so that will be 1 minus 0.1818. So that is 2, 9 minus 8, 9 minus 1, 8, 9 minus 8, 1, 9 minus 1, 8. 1 minute. So I'll find this. So then point 0.8. So I'll get 1 minus k. I got k, I got 1 minus k. So now what I'll do, I'll find every day. So 10-day exponential moving average. Then for the first day, so you know the formula. So the formula here is now the formula here. The formula, you know the formula, what formula you can use. That the today exponential moving average is equal to today closing price, today closing price into K plus yesterday exponential moving average into 1 minus K. This is the formula, you know that. Now for the first day, there's no yesterday. For the first day, like for this day, there's no yesterday. So what I'll do for just for the first day, what you do, simply for the first day, what you do, for the for the first day what you do, simply write the simple moving average. Simply write the simple moving average for the first day. Simply write what is the simple moving average you got. Simply write the simple moving average for the first day. Okay, then from the second day what you do, you apply the formula. Then from the second day you apply the formula. So formula is today closing price. This is the closing price, okay, into smoothing constant. This is smoothing constant plus yesterday exponential moving average. So yesterday exponential, this was the yesterday exponential moving average into 1 minus k. 1 minus k. You got the value. You got the value. Okay. Then for next day, how will you do? Same thing. Then for next day, what you will do? So today closing price. This is today closing price into smoothing constant uh, plus yesterday closing price. This was yesterday मतलब G. This is G. Why I'm going F? This is G. This I want G. So this is G. So this is G. So this is where is this? Which column is this? So which G14? No? So G14 and the stop is D14. Stop is D14. D14 into smoothing constant. This is smoothing constant plus yesterday exponent means G13. G13. G13 into 1 minus 1 minus F14. So like this. So you can do like this. So this is the way how we use the calculation of exponential moving average. Anyone have any doubt? Anyone want to ask any question? Anyone have any doubt, any question, anyone? So we'll do the problem which came in for you in exam. So this was the question. It came for 8 marks. Calculate the 5-day exponential moving average. Calculate the 5-day exponential moving average. We'll do here. Then 1 minute. So this is the problem. So I hope you don't mind if I do in English itself. Okay, so this is the day. 10 days are given. 1, 2, 3, 4. In Excel, either manually you can write from 1 to 10, or what you do, simply select 1, 2, 3 and drag it like this way. You can find 1 to 10. Or the other way to find 1 to 10 is that you write 1, put your cursor on 1, go to home, under home go to fill, under fill go to series, under series click on column because you want vertically, and step value 1, stop value 10. You do that, you will get from 1 to 10. So you got the value from 1 to 10. So once you get the value from 1 to 10, so let me write down the closing price. On the closing price. This is 90, 95, then 94, then 96, then 100, then 98, then 96, then 95, then 97, then 100. So you got the closing, you get the date, you get the closing price. Clear everyone? Now you get the day, you get the closing price. What they want 5-day moving average. Okay, so first I'll tell you 5-day simple moving average, then we'll do 5-day exponential moving average. So 5-day simple moving average. Although they have not asked us this, just for our knowledge, we are doing this. So we'll first here moving constant. Okay, and then 5-day exponential moving average. So 5-day simple moving average, what you'll do? For 5-day simple moving average, what you'll do? 1, 2, 3, 4, 5. So 5-day simple moving average. So you just do the full average. So this is 5-day simple moving average. Okay, so I just copy this, paste it. So I got 5-day simple moving average. I got the 5-day simple moving average. Okay, so what I did, I hope you are understanding. I simply added them. So I just added them, 90 plus 95 plus 94 plus 96 plus 100. I did this sum. So what is this sum? I did this sum. So I did this sum. So I did this sum. So 475. This 475, what I got, I divided this by 5. So I got 95. Then for the second day, what I did the sum. I did the sum from second day, 95, 94, 96, 100, 98. This I did the sum, divided it by 5. So I got 96.6. I hope you are understanding. Then for the third day, I did 94 plus 96 plus 100 plus 98 plus 96. What is the sum I got divided by 5? I got 96.8. Clear everyone? So this is a 5-day simple moving average. Once you get this, now smoothing constant for this would be 2 divided by n plus 1. N means 5 plus 1. So 5 plus 1, so means 6. So smoothing constant would be 0.333. That is the smoothing constant. That is the constant. Okay, so the exponential moving average for the first day, exponential moving average will be same as the simple moving average. Then from the second day, you apply the formula that today exponential moving average is equal to today closing price into smoothing constant plus plus uh, plus yesterday exponential moving average. Yesterday exponential moving average was 95. 1 minus smoothing constant. So again, for the third day exponential moving average, we will today closing price into smoothing constant plus yesterday exponential moving average that was 96 into 1 minus smoothing constant. So like this is this much you have to do. That's it. So you got the value. This much you have to do here. So this is what you got, 8 marks question. You got this question. If I calculate the 5-day exponential moving average in the given data, this is the way how you need it. Anyone have any doubt? Okay, I hope you are understanding this. Now, what is the application of this moving averages and all? Let's discuss the application of moving average. For that, application of moving average. Okay, so take any stock. Suppose Reliance, Relaxo footwear, click on the historical data. Now download this data. Now, so Relaxo footwear, I simply downloaded the data. What is significant for me is the date. What is significant for me is the date and the closing price here. 1 minute. So date and the closing price. So date and the closing price. So this is the date and the closing price. Relaxo footwear. Take the closing price. Once you get the date and closing price, 1 minute, let me just. So take the date and the closing price. Okay. So make the date oldest to newest. This is newest to oldest. Okay. Now you get the date from oldest to newest. Now that our work is done. So here you got the closing price. Normally, what happens? Those who are long-term trader, what they do, they use moving averages. Those who are long-term trader, they use moving average. Moving averages are basically the lagging indicator. Long-term trader, those who are long-term trader, what they do, they follow, they compare 50-day moving average with 200-day moving average. They compare 50-day moving average with 200-day moving average. While short-term trader, like short-term traders and all, those who are short-term traders, uh, it doesn't matter. They follow, they compare a 15-day moving average with 50-day moving average. Okay, and those who are day trader, normally they compare those who are basically day trader, those who are basically day trader, they compare basically 9-day moving average. They basically compare 9-day moving average with 12-day moving average. Again, your wish, whichever you can compare. One should be shorter, one should be longer. So here I'll use 9-day with 15-day. So in moving average, you can either can find simple moving average or you can find exponential moving average. That will not create as such much differences when you're doing the calculation. So here, suppose if I use 9-day, suppose if I use here 9-day simple moving average, and then that I'm comparing with 12-day moving average, that we are comparing with 12-day simple moving average. So 9-day moving average, 1, 2, 3, 4, 5, 6, 7, 8, 9. So, so you just write average here. So copy this, and this is 9-day moving average. Now if I want 12-day moving average, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So this is 12-day moving average. So you got 12-day moving average. So once you get this, once you get 9-day moving average, so you get the closing price, 9-day moving average, 12-day moving average. Now what I'll do, I'll plot a graph for this. Now I'll plot a graph, draw a line graph based on this. So you can see this. So draw a line graph based on this one. You should understand. Hmm. Let me short the. Hmm. So you got this graph. So now you got this graph. So the purpose here is to get the graph. This is the purpose. So you can see the closing price. You can see the 9-day moving average. You can see the 12-day moving average. Now you have just, if you get much more broader diagram, 1 minute. You just cut this diagram. Let me paste it here if possible. Now see this. Now see this. Now you're comparing the closing price with 90 moving average with a 12-day moving average. So blue color, violet color line is the closing price. 9-day moving average is orange color, and then the cement color, gray color, what you see, that is 12-day. Okay, so understand that your closing price should be above your moving average. So if your closing price is above your moving average, means that is bullish region. So that is bullish scenario. That is bullish region. This is the bullish. So this is bullish region. When your closing price is more than is above your moving averages. So that means your bullish region. Okay, so if in case if your closing price is below the moving averages, means it is a bearish region. If you calculate the RSI for these days, like those who are under bearish region, definitely the RSI value would be very less in that scenario. Okay, so here you can understand the bullish region. Here you can see the bearish region. Here you can see. So here what we basically do when we basically do. So whenever this the time when this closing price is cutting the moving average from the top, when the closing price is cutting the moving average from the top, it means here you should start selling the stock. It means you should start selling the stock. It means from here you should start selling the stock. Okay, you should start selling the stock. So like RSI value and all, if you see here, RSI value and all here, it will be around 70 and all. So you should sell the stock at this instances, because if the closing price is cutting the moving average from the top, then you should start selling the stock. While here you can see if the closing price is cutting the moving average from bottom, then it is creating some kind of buying situation. It is creating some kind of buying situation. But again, for this, be careful on this. Again, for this, make sure you check the ADX. You make sure you check the ADX to figure out the involvement of buying, how much that involvement of buying will sustain, so that you can figure out. Always understand that part. So here, if you whenever you closing price is above your moving averages, that shows some kind of bullish involvement. So in that bullish involvement, if you want, you can buy and all and wait for it to go up. Then you try to sell it. So in case if your closing price goes below, in case if your closing price start going below the moving averages, means then bearish situation is creating. So whenever the bearish situation will get created, so be very careful under that time. So ultimately, whenever you see the closing price of the stock, suppose this is the closing price of stock, suppose this is the closing price of stock. Okay, and suppose this is the moving averages, this is the moving average, this is your moving average. So your closing price should be above the moving average. If your closing price is above the moving average, means everything is fine. Okay, so it's a bullish environment. In case if your closing price is cutting the so in case if your closing price is cutting the this point, cutting the moving averages, these are called crossover. These are called crossover. So whenever your price, closing price of the stock, so if the closing price of the stock is cutting the moving averages, so whenever the closing price stock, whenever is cutting the moving averages, then it is called as a crossover. So whenever you get the crossover means whenever the closing price of stock cutting the moving averages, you will get the crossover. So whenever you get the crossover, here you need to understand that when we are getting the crossover, it can be of two scenarios. So it can be a scenario where the closing price can be cut the moving average from the top, or it can cut the moving average from bottom. So always understand that whenever whenever the closing price of the stock, whenever the closing price of stock, suppose this is closing price. So if this is a closing price and this is the moving average, this is the moving average. So if the closing price of stock is cutting the moving average from bottom, so this is called golden crossover. This is called golden crossover. Means this is creating a buying environment. This is creating a buying environment. So you reconfirm your buying environment, what you're getting with the RSI and MFI. So you just check your RSI and MFI for that scenario, that instances. So if they are like around 30, so then it is a good situation. You should buy the stock. So if it crossing the moving average from bottom, it is creating a buying environment. So under that scenario, you should start buying the stock. So at that situation, this should be undervalued stock. At this situation, this should be undervalued stock. So if you want, at this situation, you can check the P ratio of the company. You can check return on capital employed for the company, price to book value of the company. You can just check different ratios, values of the company. So again, they may will correlate or they may not be correlate. So you just check those values, and then whenever it's cutting it from the bottom, so the price is going from bottom to top and it's cutting this. You're getting a crossover, so this is called golden crossover. It's creating a buying opportunity. And in case when you are observing, so this is the moving average, and this is the price. So if this price is cutting from the top, so this means this is creating a bearish environment. This is creating a bearish environment. Whenever it's creating a bearish environment, then it means we prepare to sell the stock. We prepare to sell the stock. Just check the RSI and MFI of the stock at that instant, and we prepare to sell the stock at that time. Okay, everyone. So basically, moving averages are basically, we call them as a lagging indicator. So they are not, they will never create a false dummy side signals for you. So they will give you signal little bit late, but yeah. So you can be sure about the signals what they will give you whenever you talk about trading opportunities in case of them. So there are a lot of leading indicators like stochastic oscillator, William dot percentage R, William parabolic SAR. Okay, those are basically leading indicators. But yeah, so again, leading indicator can give you false signals also, but lagging indicator will never give you the false signals whenever you talk about trading by using the technical analysis in the market. Okay, everyone. So anyone have any doubt, any question you want to ask from me? Anyone have any question, any doubt, anyone? So this is from my end, from the from the discussion of moving averages. So normally long-term trader and all, what they do, they basically long-term trader and all, they will basically will go with 50-day and they'll compare 50-day with 200-day. So again, your wish, if I want 9-day exponential moving average, if I want 9-day exponential moving average, so very simple. So 9-day exponential moving average. So for the first day, the exponential moving average would be the simple moving average. Then from the second day, the exponential moving average would be today closing price into smoothing constant. Smoothing constant means 2 divided by 10 because 9-day. Okay. Then plus uh, yesterday exponential moving average into 1 minus 2 divided by 10. So then for the next day, the exponential moving average will be today closing price into 2 divided by 10 plus exponential moving average into 1 minus 2 divided by 10. So like this. These are the exponential moving average. So you can see they may or may not be seen as simple moving average. In simple moving average, we give equal weightage to the all the events which has happened in the past. But in the case of exponential moving average, we go with the logic that the change which is going to happen now, that will be more dependent on the change which has happened before that, than to the change which happened very long time back. So you know that financial market are very dynamic. So the change which has happened maybe in morning, that will not create as much significant impact with the change which has happened just now. So in the case of exponential moving average, we give more weightage to the change which has happened just now than to the change which has happened in the past, than to the change which has happened in the past. This is the logic of working on exponential moving average. Okay, everyone. Anyone have any doubt? Any question? Anyone? Anyone? Any question? Any doubt? Okay, everyone.